Happy Thursday, traders. Happy Thursday. All right, welcome. Welcome to another Technical Analysis Thursday. That's what we're in today, guys. So, welcome. Welcome. Thank you for being here. Thank you for joining me. Thank you for joining me on these very special Thursdays. Thursday is the day that I have once again started to do a weekly deep dive on a specific technical concept or technique or tactic that I actually use in my personal trading, in many cases on a daily basis. All right. And so I believe that obviously, guys, if you really take in all of these Thursday sessions, you'll build a very valuable repertoire of technical techniques, tools, tactics, or what have you that can really help elevate your level of market play. All right. Now, I did these sessions, I did a block of these technical analysis Thursdays, I think about a year ago, maybe 2 years ago. All right. And so I brought this popular series back. This will go on for some time, but I will stop in the future once again. And so I think it's very, very important to get all of these sessions in, guys. If you've missed any, I want you to do that. Even the ones that I've done a year or two back. Put all of these things together. This is going to build your technical war chest, if you will. All right. Apologize for being a little bit late as far as the timing is concerned. Had some internet issues, but I think we're settled right now. All right. So come on in, guys. Make yourselves comfortable. Grab something. Grab the beverage of your choice. I've got some lemongrass tea here. And let's do a deep dive on my next technical thing, all right, that I want to share with you. All right. So look, if I were to give me a second here, if I were to give what I'm going to talk to you about today a title, it would be this: The Mighty Wedge. All right. And its percentages. Now, I'm using a slide that doesn't really apply here, guys. It's the slide of a masterclass I did not too long ago, and you should take that in as well. All right. But what I want to cover with you today, what I want to go over is the mighty power of the wedge. I want to talk to you about how to read how how to decipher the different types of wedges, because there are different types of wedges. All right. Some of you might be familiar with the technical term, but we're going to do a little bit of a deep dive on this. So there, I want you to be able to distinguish one wedge from another, a bull wedge from a bear wedge. I also want to help you incorporate the concept of percentages with your wedge reading. Okay. And we're going to use the wedge and percentages to actually come up with potential projections of what your item potentially can do because of the wedge. The wedge produces certain tendencies, the wedge produces certain probabilities. And so I want to go over how we potentially can utilize the wedge, its percentages, to also project what might happen next in the underlying item. All right. So without any further ado, let me go on and start. Now, playing the wedge and its percentages. The first thing I want to do is I want to demonstrate what I actually mean by a wedge. And we're going to cover the bullish wedge first. And I'm going to draw this out for you. All right. There's a benefit in me drawing it out versus just showing you. I've learned this over 30 years of training traders, that watching me draw certain concepts out does help you retain the concept a little better than just showing it to you right off the bat. So I'm going to draw it for you in this case, right? So I want you to assume that your underlying item, whether it's a stock, whether it's a cryptocurrency, whether it's an option, a bond, it doesn't really matter. The underlying item doesn't matter. But I want you to assume that your stock has had a fairly decent run to the upside. So there has been a push, a run that is a decent run, not a feeble run, but a decent run. And your item, your stock or whatever it is, has started to drift back to the downside. All right? Now, I'm going to draw that drift like this. This drift is what we would call a wedge. Okay? There are different types of pullbacks. One of the pullbacks we're talking about is actually called the wedge. All pullbacks are not wedges. And this is what I want to talk to you about now. A wedge is typically that 45-degree angle-ish, for lack of a better term, or less. 45 degrees or less drift to the right. So this is what, so 45 degrees more or less. You can have a wedge that is less than 45 degrees. But when you start to get into pullbacks that are sharper than 45 degrees, that is not a wedge. Okay? Important to understand. These general degrees mean something. They're very important. This is a wedge. This is what I deem as more of a collapse. There's a difference between your stock collapsing and your stock wedging. What will tend to occur after your wedge is complete is a continuation of the first part of the move. The first part of the move was an up move. Then you rested in the form of a 45-degree or less wedge. And after the wedge or the resting period was over, you continue one by producing leg two. So this is a part of a two-leg movement, interrupted by a brief or relatively brief 45-degree angle wedge. Okay? So the key thing to understand is that bullish wedges that are 45 degrees or less tend to be continuation patterns, and they continue what happened before the wedge. So what happened before this wedge? This happened before the wedge. Now, the 45-degree angle wedge or less, 45-degree angles or less, I'm going to keep saying that. This wedge typically is an indication of nothing is wrong. The underlying item is just resting and preparing to catapult itself into leg two. Now, leg two, what we can do is we can take leg one and project the length of leg one on the right-hand side of the completed wedge. Boom. That's a quick and dirty way of producing what I call, guys, is a measured move. Now listen, being able to read or project measured moves is a very important part of technical trading. But what I find is that many novice traders who are even taught this, they take it too far. They think that it's an end all, and they take it too seriously and too minutely, where they start pulling out rulers and taking out their geometrical tool. Let me pull out my right angle and measure that. It's not. It's a general guideline. I just need you to understand that. It doesn't mean that that's what's going to happen, but we need some type of roadmap, some type of general idea of what is possible. And so a measured move is more of what is possible, not what it should do or what it's going to do. It's a rough roadmap of what might lie ahead. All right? Don't let me catch you being one of these nerdy guys. I mean, Oliver, but what do you mean by measurement? How many centimeters and that? We're not playing. That's not the way you play the market. All right? We can't be that specific. I just need you to understand that. All right? All right? Don't be a freaking nerd. Okay. Now, we've measured the length of leg one, projected that same length on the right-hand side of the wedge to come up with a general idea of what is possible, okay? And that is called a measured move, okay? Now, let's talk a little bit more about the difference between this bullish wedge and a collapse. In both of these cases, you've got a nice bullish run to the upside. And in this case, you get the nice 45-degree angle, nothing serious, nothing sharp, just kind of like a drift, if you will, a drift, okay? In this case, you get a collapse. When you get a collapse, the odds of a new high drop precipitously, which means that the greater odds, the greater probability is that your next bounce fails to make a new high and you drop to a new low. That's the very high probability event if your drop after a run is sharp and straight. The wedge is not a drop, it's a drift. It's as if, you know, the way I explain it to kids, guys, is because I have a trading kids program where children from 10 to 15 learn my trading tactics, and I actually fund them. It's crazy. It's great. And they trade better than you. They do. I'm sorry. Kids trade better than you. Hands down. Right? So the way I explain it to the kids, I'm going to try to explain it just like I explain it to the kids, because you're kids too in a way, is imagine a mountain. You ever see those hang gliders that kind of take off from the top of a mountain, right? And they glide down the mountain. They glide in a very controllable way. They glide down the mountain. But imagine one of them getting ready to take off, and under his foot, he loses his footing and he falls off the mountain. That's not good. Falling off the mountain versus gliding off the mountain are two very different things. And in these two pictures, you have exactly that. You have a glide down the mountain. See him gliding down the mountain. Glide down the mountain versus, oh my God, I'm falling straight down. Look at his feet. So we don't want to play from the bullish side the collapses from your mountaintop. All right? We don't want to play the collapses. The collapses usually bounce and fail. but we do want to play the 45-degree angle glides, the wedges, the 45-degree angle. Less is a glide, it is not a collapse. And when you come out of the wedge, boom. As soon as you break the wedge, you're off to the races to potentially repeat whatever happened before the wedge. Whatever happened before the wedge, you can project into the future to come up with a possible outcome for leg 2 on the other side of the wedge. Now, there is one thing before I go to a chart to show you an example of this. There's another concept I have to explain to you called percentages. I've got to bring the percentages. We've got wedge versus collapse out of the way. We've got projecting a measured move. We've got that concept out of the way. Okay. Now, so we've got wedge versus collapse, boom, done. We've got how to project what possibly can happen from a bullish wedge through the measured move concept. Number 2, done, good. Now number 3, percentages. All right, this concept is just going to take your understanding to very, very high heights. All right, check this out. Percentages. Let's get back to the bullish wedge. Okay? Now, I want us to take leg 1, the first leg, before the wedge. All right? I want us to split this into a half. So that's 1/2. We split the up move in half, but I also want you to split it in thirds. We don't have to be exact, but you know what I'm saying. Okay? So we've got the top third, we've got the middle third, we've got the bottom third. We also have the top half. All right? So maybe I should even do this in a different color. So we've got the top half and the bottom half. All right? Top half of the move, bottom half of the move. But we also have thirds. We've got the top third, the middle third, and the bottom third. Now, when your wedge stays in the upper third, okay? Hear me out clearly. This is a percentage, 33%, right? When your wedge stays in the upper third, this is the most bullish wedge. So the odds of repeating 1 over here to create 2 is the highest. The odds of getting your projected target is higher. If your wedge breaks the third and stays above the half, it's still okay, but this will tend to fall shorter than this one. So your projection, if your wedge drifts too long and deep, but it still does not violate the halfway mark, it's still okay. It's just that your move up is going to statistically be shallower than, or less powerful than, the move from the wedge that stays in the top third of the prior move to the upside. This is the prior move to the upside. All right? Guys, this is gonna really fine tune your mastery here. There aren't many people who know this type of detail. You understand? If you break a half, if your wedge keeps going and breaks a half, it's over. Like the move up is going to tend to statistically be a failed move up and actually go into new lows. So we want our wedges predominantly, the best ones stay in the upper third. The okay ones stay in the upper half. And the bad ones break the half. All right? But the top third is the creme de la creme wedge. Those are the ones that I want you to predominantly focus on. Okay? So, once again, you get this move up, you get a wedge type formation. Boom. We see that this wedge is staying in the top third of my move up. Top third, middle third, bottom third. You get the point. Okay? This is your most bullish wedge. So now what potentially can come on the other side is equaling leg one. Okay? Once again, if this wedge continues too long, you now have greater odds of this just being pointing to more downside. This is pointing to more upside. You see? More upside. But if the wedge keeps going too far, okay, it's pointing to more downside. And remember, if you collapse, that's completely different. That's pointing to more downside too. All right. Okay, I'm curious. Do you follow the concepts that, let me know? I want to see your comments. You follow the difference between a wedge and a collapse. 1, 2, you understand that a correct wedge is 45 degrees or less, right? You understand how to project a possible target from a good wedge. You know how to split your up move into thirds and a half, and that if you break the third is the creme de la creme, half is okay. If you break the half, you're pointing down now. All right? Let me know if you understand this. I want to see some of your comments here. Let me see. Let me know. Talk to me. Make sense? You got it? Yes, you follow? Good, good. Birdie says yes. Okay. Hank says yes. Do well. Yes, 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 yes. Fantastic. All right. Now, let's take a look at something. Shall we? Shall we take a look at something? Shall we? I want us to take a look at, do this. Give me a second here. Let's take a look at this. Let's take a look at one of my favorite things, guys, Bitcoin. Now, because this is an asset that I don't trade but hold long term, I have to look at a big time frame. But I want to show you this concept. I'm going to show you this concept with a real life thing here, Bitcoin. What you're looking at is a monthly chart of Bitcoin. All right, it's one of my favorite time frames to look at. One of them, not the only one, but one of them. Stepping back, and here's the entire history of Bitcoin on the monthly chart. But I want to zero in on now. Okay? So let's put Bitcoin in this context, in the context of our lesson today. So here is Bitcoin's cycle low right there. We have the move to the upside. All right, there's your move to the upside. This, and we did have an interrupt in that move, but that's fine. Nothing wrong with having an interrupt there. But this is your move to the upside, okay? And this is what you can consider to be leg one, okay? Now, guys, leg ones do tend to have an interrupt that is a great adding opportunity. So most leg ones do have an interrupt within the leg one. So it looks like this. And that would be your entire leg one. All right. So the goal would be to try to get in of leg one at the bottom, near the bottom, add not too far above that, and then try to enjoy the rest of one. So my traders are always taught enter, add. You understand? That's how you play a leg one. You enter, I'll do it like this. You enter, and then you add on the first pause. That would be the first pause. So enter and add on the first pause. Enter, okay, and add on the first pause. Enter and add on the first pause. All right. And if you look at, hope this is bleeding through okay. But if you look at, here's your entry, green taking out red. Here's your entry in this area. Here's your add, first color change here, in this area. And this is still part of leg one. Okay? Now, what you see happening here, guys, what you see happening, I'm just going to pull this up and make sure that we are bleeding through, okay? Give me a second here. Go to my own live here. Yeah. Give me a second here. Okay. Good. Got you right here. Give me a second here. So, now what you can clearly see, guys, is that from this peak, you are wedging. Can you see that? Is that clear? Can you see the 45-degree angle or less of a wedge? Let me know. I want to see this. Talk to me. I want to see your comments. I want to actually see your comments. I want to see if you can see this. Just a few of you let me know. I don't need everybody to tell me. But I need to know you see it. You see it? Yes? Good. Okay. Now, tell me, is that wedge in the upper third? Is it? Is it in the upper third? Tell me. Tell me. Is it an upper third? Upper third wedge? Do we have an upper third wedge? Oliver, we have an upper third wedge. Yes, we do, right? There is an upper third wedge going on. Now, remember, we're supposed to take what we're supposed to do, right, is we're supposed to split this in half. We're also supposed to split it in thirds, like that, right? You know what I'm saying. We can, more or less. And so we've got a great 45-degree angle or less wedge developing in the upper third of Bitcoin's first cycle move. Now, what's crazy about this is that statistically speaking, The year after Bitcoin's halving is the exponential year. Almost every cycle, it's the year after the halving. So Bitcoin's halving year is 2024. The next year, 2025, is the meteoric one statistically. This has happened every 4-year Bitcoin cycle. So doesn't this wedge sort of play perfectly into 2025 being the meteoric year? Basically, meaning that we potentially can take leg one, this is leg one, and project that bad boy on top of the wedge. That's freaking insane. Do you understand? That's insane. So, the way you would do that is basically what's the percentage move from here from 15,500 to 74,000? And then you project that percentage move from the beginning of here. It's insane numbers. You understand? It's insane numbers. But I'm not saying that that's what Bitcoin's going to do. I'm just saying that, guys, for 30 years, I've been playing this technical concept, and I know how to come up with a measured objective using wedge analysis. All right? It's crazy, right? Yeah. So someone's saying, yeah, 345%. So what's 345% from 60 if we come out of this wedge? All right? You see what I'm saying? So that's crazy. Okay? Those are crazy numbers, but we know Bitcoin can produce crazy numbers. It's produced the craziest numbers in all of recorded history. So it's not out of the realm of possibility. All right? But I want you to be able to do this, guys. You understand? So it's not just, I don't want to get on here and talk about just Bitcoin. Well, I kind of do, but my goal is to give you something, a tool that has you capable now of seeing deeper than the majority of people out there. I'm telling you, people, with what I'm teaching, what I've taught you here today, you're able to clear out a lot of nonsense noise. You understand? And people not understanding, for instance, this wedge theory are all negative on Bitcoin. This is the wrong thing if you understand wedge analysis. You understand? It's the wrong thing. Okay? So with this, you're going to be able to, if you get this right, some people are going to be marvel at your ability to predict what's next. You'll be right more often than wrong. Next move is up, not down. And they'll marvel at your ability to come close to how far that move is going to go based on the measured move technique I taught you. Now, let me see if I can just show you one other thing here. All right. We'll see if I can show. Give me a second here. All right. Now, let me see. Give me a second. Give me a second here. What I want to do is, I'm going to have to draw it. I'll draw it for you. Okay. The last thing I want to do here is I want to make sure you understand what a bearish wedge is. Okay? because we talked about a bullish wedge, right? All of this is up, all of this applies in reverse as well. But let's very quickly go over a bearish wedge. See, your bearish wedge, even in an up move, tends to happen like this. And then the wedge develops like that. Now, I think it might be too strong to call this a bearish wedge, but these wedges tend to break down. They don't tend to go up. I'm not saying that's not impossible, but the more bullish wedge is cooling off the stock. Do you understand? That pullback, that giving back some of the price is cooling off the item from its powerful leg one move. That cool off allows your stock to leap forward with a vengeance. You see? It's like giving it some rest, stepping back, if you will, so that it can leap forward again. When you don't provide that rest, it's not recuperated enough to produce another run to the upside. There has been little rest. There's not much recuperation, so these tend to break down. The wedges that drift upward tend to break down. All right? You got this? We want the wedge to drift downward. We don't want the wedge to drift upward. Tell me you understand this. All right? Make sense? I'm looking at your comments here. Does that make sense? Upward wedges tend to break down. It's the retracement wedges that are the most powerful. You got it? Let me see here. Cool. Nice shirt. Dude, we're talking about money-making tactics here. Why are you focusing on my shirt? All right. Beautiful. Beautiful. All right, cool. So, there you have it, guys. The mighty wedge, right? So there you have it. The mighty wedge. Guys, this is an event that forms quite regularly. Okay? It's not something that happens every now and then. This is a regular occurring thing. So let's summarize here. Your item has a nice, strong move to the upside, but now it's stalled. Okay? The $64,000 question, people, is it over? That's the $64,000 question, right? It's had a powerful move. Is that it? Is it over? Is it now time for reversal? It's starting to come back in off the highs. Is this a sign of danger? Should I run for the hills? Or is this just a pause? This will separate you from most of the masses that cannot determine whether a price pullback is a bullish event versus a reason to run, to get the heck out of Dodge, if you will. You know, most people can't do that. Oh, but it's starting to fall back. Well, all fallbacks are not created equal. Some fallbacks are beautiful and actually should be looked to be bought, and others are warning signs. Let's get the heck out of Dodge. Boom. Most people can't decipher which is which. Now you can. Wedge is a good pullback. Collapse, the angle is too sharp. That is, get the heck out of Dodge. Okay? In addition to that, even a wedge can go too far and start being negative. You even know that. You break a third, okay, it's still okay. You break a half and it's over. I don't care how beautiful the wedge looks, it's just too far. Okay, you know that. You know how to take the up move, break it in thirds and a half to measure the best wedges from the okay wedges to the fail wedges. Third, top half. Break the half, bad. Okay? Best of the best, they stay in the top third. Okay? You also know how to come up with a profit potential target using the measured move. Now, this is a very, very powerful concept, guys. Very powerful. And with this, you can separate yourself from a lot of other market players out there. So now what do? You go to work. That's what you do. What's that work? Go out into the market. Look for these things. Take snapshots every time you see one. Check out the ones that work, even the ones that fail. Gain some experience with this. Play a few of them. Make some money. Lose some money. Turn the knowledge into experiential knowledge through dealing with it. All right? That is your assignment going forward this week until next Thursday. Wedge play. All right? Go to work, guys. Trade well, and I'll see you next Thursday. I'll see you next Monday for Q&A as well. All right, guys? Ciao for now. Boom. Boom. Boom.